Once again, this is the Cameroons while we let everybody pile in here. This is my band, once again, the Cameroons, live at the Capitol Theater in New York, featuring Joe Andrews of Old Crow Medicine Show, Ben Cameron, independent artist, songwriter, Lucas Lee on piano. And there I am. A little Grateful Dead for you. Yes. That's Joe Andrews right there. You can dance if you want to. Lucas Lee on piano right there. Played with Jerry Lee Lewis, Miranda Lambert, Ashley Monroe, and the Cameroons.
No time to stash the gumbo. We're riding around in a cage. The sacrifice jars make bubbles. Spitters everywhere in rage. In a hot sand, a ring of my feet. Blistering cake with debris. Shares for layers guarding the toe port while I break pillows for clean. Now there's a run. Eagle flies. What's the word you love? Love the one you with. Love the one you with. Love the one you with. Love the one you with.
Okay, we're about to start. All right, gang, that's it. All right, we're going to start the webinar now. Hope you enjoyed that. I didn't realize I didn't have the volume up, so you might not have been able to hear the original song at the beginning, but you can go to our website at thecameroons.com and see a bunch of videos and hear, and there's a lot of pictures there. And, you know, we're a lifestyle brand now, so you can enjoy it. So I'm going to start this webinar. We're entitled Sinners in the Hands of an Angry Fed, and I'm going to describe how the government response to the COVID crisis has been unprecedented by far, and we don't know what the outcome will be. Right today, we have a bull market, but there's no telling what burdens this will leave us. So at N3L Capital and at Trusco, the two companies I'm associated with, and Garrick Moran, who's our trader in gold and silver, precious metals expert in Atlanta. This is our team, part of our team. We look at graphs and data all the time and pictorials of data. And so the best, I guess, pictorial of the new norm that I've seen after looking, you know, at all kinds of data is this one right here. So that's the new norm, and we're going to have to deal with that for a very long time, I'm afraid. Okay, now that you're chuckling on that, I'm going to move on to COVID and a couple of observations about COVID, the unprecedented COVID issue. And the most amazing thing is the unprecedented use of the word unprecedented. When you search Google Trends, you see the use of this one word obviously exploding. This is the R naught, which is the rate of infection. And you can see where the states that have opened up, if you will, where they are now allowing at least partial gatherings and people to be able to go out. You're seeing that the R naught, or the infection rate, is actually falling in the states that have liberalized or that have opened up somewhat. I thought that was very interesting. Here is a knock-on effect of the shutdown and the crisis in the economy. That crisis is real for so many Americans Stock market speculators are making all kinds of money, but the rest of the world's suffering mightily. And this is literally a poll, and for every 100 American adults, 34 show symptoms of anxiety, depression, or both. And this, I'm sure, is from the small businesses getting hit, people losing their jobs. This is all economic. So the knock-on effects of the COVID lockdown are much more serious, perhaps, than COVID itself. Another interesting result of this is that more people are going to want to work at home. I worked at home for almost 3 weeks and loved it. I didn't have to commute. Thanks to the wonders of technology, there was no decline in productivity. A number of the companies that we follow and we listen to their conference calls have told us that, for instance, their Salesforce productivity skyrocketed when these people were at home. Companies had no idea that they could send 40,000 employees home and not miss a beat in regard to productivity, but that is exactly what happened. So the new norm will be very interesting. My guess is that fewer people will be going to the office, and that, like, for instance, office REITs and office buildings are going to be in trouble. This is the greatest monetary fiscal expansion in history. And we're going to talk about inflation. Right now, the inflation is only in the equity markets, and I'll go through that. Here's a long-term chart of the U.S. monetary base. The red line is the monetary base, and the blue line is interest rates. It goes all the way back to the Great Depression. So obviously, this chart shows that monetary stimulus is off the chart, literally here. This is just another picture of the same thing, the most accommodative monetary conditions on record relative there to the S&P. The Fed is literally monetizing our debt dollar for dollar now. The top table, you can see if you look closely and you squint, is the 2019 is the 2019 period. The public debt was at $16 trillion, and in 2020 it's now $19.4 trillion. So almost a $3.5 trillion increase in the federal debt. And that is the exact increase in the monetary base. So the Fed is literally printing the budget deficit right now, which will lead to inflation. Currently, it's only in financial assets, but we believe that this will show up in inflation with probably a 6 to 8 month lag. This is a topic that no one is discussing. Everyone thinks prices are set to collapse. We're seeing prices rising of food, for instance, which has been in the press lately. Fresh vegetable prices are up 18% year over year. We think that's just the beginning. Here's the federal budget deficit monthly, and you can see where it is in extraordinary negative territory, the deficit that is. Here is deficit as a percentage of GDP compared to some other countries. Look at Greece. We're doing a lot worse than Greece. Here is the projected deficit, the greatest in U.S. history. The only time that it even rivaled this was in 1946, after World War II, when it was at 116% of GDP. It's projected to hit 124% of GDP by 2030. Some projections call for it to hit 150 or 160% of GDP by 2050. And I don't think that is a stretch at all. Here's the Fed funds rate, which is the futures curve, which is investors' expectations for Fed funds, and that's interest rates. And look how it goes negative. So, and it's getting more negative as the expectations are. The Fed has declared that they're not going to let rates go negative, but expectations now among investors are that they will. There are ramifications to that. Back to the debt bomb. I showed this chart in prior webinars. This is webinar number 4, by the way. 60% of NASDAQ companies had junk bond debt coming into the COVID crisis. This is covenant light loans. So this is the number of companies that have debt that has little recourse for the lender. And so that is also a sign of significant risk. And then here lately, U.S. companies have borrowed almost a year's worth of cash in 5 months. You can see the blue line at the far right of this graph shows that up to May 26, companies have borrowed more than they usually do in many years. And that, of course, is crisis borrowing. So they come into the crisis with a record amount of junk bond debt, a record amount of debt generally, a record amount of covenant-light loans, and now they're taking on even more debt, which the Fed is accommodating through their quantitative easing program here. This is commercial and industrial loans among all commercial banks, and you can see where it's skyrocketed. This probably includes or does include banks that are drawing down their lines of credit anxiously to make it over the trough in the economic slowdown. I'm going to go over some of the market characteristics right now because so many people ask me what is going on with this market. It continues to climb higher. And my answer is that when the Fed embarks on monetary easing of this magnitude, again, unprecedented in history by some measure, by quantities, multiples, if you will, the first place that this inflation shows up is in financial assets, because remember, they are buying treasuries from banks and they are relieving banks' balance sheets of their treasury debt, paying up for those treasuries, and then injecting new money into the system, and that goes into the stock market. They're also buying junk bond debt, which you may know. They're even buying ETFs. In fact, during 1 week, about a month ago, the Federal Reserve spent over $1 trillion on treasury debt. The idea is that, let's say that the 60 people on this webinar comprise the entire debt market, and we are trading among each other every day, reaching prices are set every day by our behavior, our buying, our selling, and then here comes this incremental buyer with over $1 trillion to spend. By the way, they do not care about getting a bargain like we do, like you and I do. They have a sense of urgency that's unprecedented in history. They want to spend this $1 trillion this week. What do we do as participants in that market? Well, we buy with them. And that's exactly what we are seeing in the equity markets. How high can it go? How much can it continue is a real question. And my guess is it can't last forever, but we won't know ultimately until we see a crash. This is a sign of what's going on when we watch the markets night and day. Our cohort Garrett Moran watches the futures market in the wee hours of the morning. And if you look at the performance of the S&P overnight, the red line, you can see that it is very strong. The day session performance is much weaker. We and others think that this is market manipulation by way of our Federal Reserve, but really through the Bank of Japan. There are a lot of theories out there that the big $500 billion swap line the Fed opened up with the Bank of Japan is allowing the Bank of Japan to buy S&P futures in the wee hours of the morning so that we don't wake up with the market limit down like we did for several weeks back in mid-March. They're propping up the market so that we can sleep better at all costs. They're going to prevent a market meltdown at all costs, and they are perfectly willing to sacrifice the future, the value of the dollar, our well-being for today's peace from a violent market. And this is just an extraordinary chart. By the way, you may know the Bank of Japan owns over 50% of the Nikkei index, the Japanese index. They own ETFs. They own a significant portion of the S&P, and they're currently buyers. And we think, again, that the Fed might be the puppet master there. Here's how expensive the market is. The S&P 500 12-month forward PE is at, well, now it's almost 25. So here we are. This is inflation in financial assets. We've been looking for an opportunity to make money in the midst of an inflated and we think bubble market. And value is always cheapest during recessions, but it's never been this extreme. These are value stocks of the S&P relative to the broad S&P. And this shows that value stocks are extraordinarily cheap. And by the way, almost all of the performance of the S&P is concentrated in a very few names. Today, for instance, the FANGs. And so it's a narrow market. It is the performance is not broadly dispersed among the S&P. It is very unhealthy ultimately. And again, we are looking for a turning point in value stocks. We're hard to chase a company that has no earnings that's trading at 40 or 50 times revenues for your average investor. So we think that there may be a great opportunity in value stocks at some point, if not right now. And this is basically a sign where that might be the case. Now, this is put-call ratio, which shows bearishness and bullishness. And right now, we are at bubble levels of bullishness. And again, it predicts or suggests that we might have a market turn pretty much any day. Now, the deal is the Fed's going to fight this in the overnight hours from that chart I showed you earlier. They're going to be fighting this. We'll see if reality versus the Fed, who wins. And then this is just a picture of what hedge funds are doing. Net buying, they're not buying anything. In fact, they're moving market neutral, and they're selling and they're shorting. So they are expecting a reversal. They are looking probably at this very chart, which shows sentiment at an extremely bullish level and expecting a turn. As by the way, we are. This is how bad the economy is. This is the New York Fed Weekly Economic Index. It was published the other day. And look at 2008 and 2009. It's much, much worse. Can you believe the markets wants to go to all-time highs amidst this kind of meltdown? Well, the Fed, remember, we are sinners to think that prices of stocks would ever reflect reality. And we are in the hands of an angry Fed. That reference, by the way, is from John Calvin. You may know that already. This is the International Trade Index. Trade is collapsing. Another thing that we're very worried about is globalization is over. And the trade spat between the US and China is getting worse by the day. You've got the Hong Kong stress. They're clamping down on Hong Kong. By the way, Taiwan recently expressed their solidarity with the Hong Kong protesters. We recently authorized the sale of 18 F-15 fighter jets to Taiwan. And so what we think is that the trade war between the United States and China is revolving into more than just a trade war. It's actually evolving into a global conflict, and it could be extraordinarily bearish for trade, which has been extraordinarily positive and bullish for our economy and prices. I think I went over last webinar how a big driver of deflation over the last decade has been our ability to acquire cheap goods from China. China's manufacturing operation is optimized for manufacturing for Walmart consumers. And in fact, they've got a logistics system that's unparalleled in history and unparalleled on earth. So when we break that chain, we should see a price response. I think it will influence inflation of goods going forward. But we had hoped for a trade deal, first phase trade deal, second phase. Now I think that you can just take that off the table. I don't think there will be a trade deal. So it's pretty bearish for the economy, probably bullish for stocks. This is unemployment and mortgage loan delinquencies. You can see they track each other perfectly. And then here unemployment is, by the way, 2.1 million people filed for unemployment claims today. So it was a very, very big number. And mortgage loans past due has not responded. It usually does with a lag. This would suggest that defaults are going to be significant unless, of course, the government bails out the consumer to a greater degree. And they're already talking about a $2 or $3 trillion bailout, another stimulus measure. Just driving our debt and deficits higher, just causing the Federal Reserve to print more money, not less. What we're doing is unprecedented, and it's going to get even worse. Just to let you know, in order to fund the federal government deficit, the Treasury issues bonds, and investors buy those bonds, and with that money, they operate the government. The amount of bonds the Fed is going to have to issue to sustain their $3 trillion annual budget deficit is, again, unprecedented. Let me use that word again. And the weekly auctions are going to be enormous. They already are. And there aren't going to be enough buyers out there to absorb that to supply, and especially with interest rates at zero. Who's going to buy it? The Fed. So let's fast forward. Here we are in May. It's almost June, July, August, September, October. Hopefully I'll still be doing these webinars. But in the fall, the amount of Treasury issuance is going to remain at very, very elevated levels. The Fed will be buying them that many months in advance. So what the Fed's done so far is nothing compared to what they're going to do in the future. Here we are. This is a shocking chart. Continuing claims for insured unemployed. And that's the red line versus the NASDAQ. Pretty bullish, isn't it? Well, maybe not. It's today, the worse the economy gets, the more stocks go up until something changes. Here's the credit conditions index that we look at, and it shows that they're worse than they were in 08 and 09. The lowest reading ever on this index shows how businesses, despite widespread government support, are struggling to pay their bills, their rent, mortgages, etc. And it's not going to get better, gang. We may have a V-shaped recovery in the market. We will not have a V-shaped recovery in the broad economy. Companies are going to get by with fewer employees. That's a fact. And they're going to be able to find, replacements for employees. We're going to have maybe a U-shaped, but probably an L-shaped recovery. And I'm not even predicting a recovery. You could see, for instance, in July, a sequential improvement of the economy that's like eye-popping, by the way, from June lows or maybe May lows. But year over year, it's not going to go positive until we cycle against March, in my opinion. So they're going to be touting the strong, explosive growth on CNBC, sequential growth in the economy as we rally from the depths of hell. But versus last year, remember, it'll be well underwater, and we will remain in economic doldrums for years. Here's just another picture of the debt in the U.S. small cap stock world, aggregate net debt to EBITDA. Again, right here at record levels. So a lot, 70% of the NASDAQ is not making money. And I already said over 60% of it has junk bond debt. And we've just seen from the chart before where debt issuance is increased dramatically. We are in a world, folks, that is so engorged with debt that it is, again, unprecedented, if I can use it again, on the corporate level. And the government is just taking that debt over, which will mean higher tax rates in the future, substantially higher tax rates. 70% highest marginal tax rates are probably in our future. And it all depends a lot on the election, which I'll go over in a minute. By the way, we're going to do Q&A at the end here, so get your questions together. Oh, I already showed this turning point for value. Sorry for that redundancy. I'm going to run through China real quick because of the trade issue, but they're no better than we are. When you look at their debt, this light green bar on the far right just shows that the China's local government financing vehicles are issuing more debt than they ever have. You've got, this is a breakdown of financial, government, household, and non-financial corporate debt in China. Again, all-time high, climbing. Here we have government bonds in China. They've got local government bonds, general bonds, central government bonds, and special treasury bonds. Look on the far right. Unprecedented, may I use it? Eye-popping, may I use that one? Again, we're not alone. They're even worse there. Europe. The UK, they call this the gilt, G-I-L-T, two-year government bond yields in negative territory. So that's where the U.S. federal funds rate is likely to go. Remember, I showed you the chart earlier. Investors are expecting negative rates. It's hard to fathom this. This is the European monetary base. By the way, just yesterday they announced a massive new ECB program buying bonds, trillions and trillions of dollars of bonds. Okay, before I go into my favorite idea, I'm going to talk about what it's like when a government like Pac-Man consumes all of this private market debt. It's like, debt is like a cancer, and the government just took it out of the private sector, pulled it on to the public sector. They will never be able to pay down that debt ever. We used to pretend that they would. And of course they cannot now. It's over. I'm getting a text from my friend Bobby Kaner, who has a chart for me, I think. That's funny. It's about the word unprecedented. Anyway, so again, they will never be able to pay down this debt. They're not even going to try. They're going to monetize the debt. They're going to print more and more money to pay down the debt, and to maybe even if we have the wrong party or the wrong group, let's say, not party, neither party has a monopoly on bad ideas. Okay, Democrats or Republicans, they fail us constantly, and so it doesn't really matter. However, if we do get a far left regime, they will directly monetize the debt. They will quit the facade of buying treasury debt to inject money into the system. They'll probably just write checks directly to, for instance, infrastructure spending, or just send people a basic income check from now until forever. Oh, and by the way, regarding unemployment checks, they're going to expand those. They're going to go past September. They're going to go, well, Obama did them for 99 weeks. We're becoming Europe. We're becoming maybe even worse, Japan. Our vibrant, creative destruction, you've heard that term. Milton Friedman coined it to describe our fabulous economy, where if you're misallocating capital or resources, you simply go under as a company. Not anymore. The government's going to bail you out. The more profligate you are, the more you can guarantee a bailout. When you look at the market performance since the March lows, the companies that have performed the greatest are the ones with the most debt. They're the zombie companies that have declining revenues, negative cash flow, negative earnings, and those are the companies that have snapped back the most. So in the old days, of course, those are the companies that would have gone out of business, restructured, gotten rid of that debt, restructured that debt, like I said, and started off again lean and mean. Or maybe another company would have come in and bought those assets, taken over those employees, and put them into better use. You cannot grow an economy full of zombie companies that are being bailed out by the nanny state. We are going into a secular growth rate decline for generations, and I guarantee it. There's no way we can grow under the burden of this kind of debt. And just wait till tax rates increase. So what do? Well, you can own the FANGs for now, because that's the only thing performing. But it's very risky and very scary. And at some point, it will reverse. Or you can own precious metals. We think a major bull market in precious metals has begun. Gold prices have performed very well. Silver is still at a record low relative to gold, by the way, right now. So you can still buy silver. But the coolest investment of all is the miners. The cheapest gold in the world, Garrick Moran reminds us every day, is in the ground. The miners, they're trading at modest multiples. So here we are. I'll read it to you. Precious metals equities were the best performing stock sector in the 30s during the Great Depression, the 70s during the Great Inflation, and the 2000s, including 2001, 2008. All 3 decades were bear markets. They've started a major bull market every time the Federal Reserve has responded to a financial crisis, as they have today. And then, in 2001, the Fed cut interest rates. The Barron's Mining Index rose over 800%. So we think there'll be hundreds of percent gains in this group going forward. I want to leave you with that idea. The reason I want to leave it with you is because every one of my friends and every one of my professional investor friends is flummoxed and perplexed at the market. It's hard if you are an investor that focuses on value, that worries about paying too much for a stock, to chase this market. It makes you sick to invest just because the Fed is bailing out zombie companies. There's something distinctly wrong and, in fact, dirty about it. It's tough on thinking individuals. Now, if you're a millennium putting a few $1,000s through Robinhood into whatever's working, that's one thing. I don't think we're going to have a very good outcome here. and I'm very cautious. But this group, I'm not cautious about. I think we got a bull market underway. It's simple math. I'll go over it real quickly. The price of the commodity is $1,730, I think, today, gold, is about $500 per ounce higher than it was in this period last year. So miners are seeing a $500 per ounce increase in the amount of money they can charge, right? We're assuming their costs are stable. There's not much debt among this group because they went through a pretty significant downturn and bear market, so they rationalized their debt levels. The only industry group with little debt relative to cash flow, I mean, very little. They're trading at a modest multiple to cash flow, 5 times, call it, and their cash flows are growing 30% year over year. And the M&A activities just started to begin in this group. The high multiple big cap miners, Newmont, Barrick, they don't have a lot of growth in production. They don't have a lot of gold in the ground. They're going to buy it. And they're going to use their inflated stock prices to buy these junior miners that are trading at multiple discounts of over 50%. So in my long career of watching industries and stocks, I've rarely been more excited than the setup here. Not just because gold has a strong macro tailwind. It does. We've seen the debt. We've seen the deficits. We've seen how it behaves in the 70s, in the Depression, 01, 08. We've seen that. The macro backdrop could not be stronger. The major hedge fund managers, Ray Dalio, Paul Tudor Jones, Stanley Druckenmiller, are all buying gold. Oh, by the way, central banks are buying gold. Record levels of it. Central bank buying of gold hit a record in 2019, and it's continuing. So that's the commodity, but rather than chase a commodity, buy a producer. The cheapest gold in the world is in the ground. These companies are going to be putting up huge earnings numbers over the next several quarters. They're going to be blowing out numbers, while the rest of the economy is not. I don't care what the stock prices are doing. We're going to see companies missing earnings like mad. And by the way, up until today, it just means the stocks go up. At some point, that may not be the case, folks. So please don't go chase those stocks. You can find a hiding place here that has very good growth characteristics, very good balance sheets. Like I said, it's a safe haven with earnings outperformance coming. So there's a temporary gap here between inflation and expectations. So everybody's been talking to me about inflation. Where is it? Where was it in 09, 10, 11, 12, 13, 14? Where was inflation when the Fed started QE1 in 2012, QE2, QE3? Where was inflation? And I argued before in prior webinars that several things were basically countervailing forces. One was the China effect. Cheap goods from China pressured the prices of goods. And it was a wonderful, beneficial period of time for us. That is now being interrupted. The gains from trade are now nil and maybe working against us. I talked to the director of the National Association of Importers and Exporters, a large Washington, D.C. Advocacy group for major corporations, and she told me that she thought 25% of production would leave China. What does that mean? It means higher prices for goods, period, end of story. And what about all the production shutdowns? Look at pork prices right now, beef prices. They've had to shut down the 3 giant beef processors in the country, and prices are skyrocketing as we have scarcity. They're destroying carcasses right this minute of swine and cattle and chickens. They're destroying product that they spent money on, CapEx, producing it. There will be a ripple effect to that. Housing prices are rising, and that will increase as scarcity comes about. So here are inflation expectations versus CPI. The green is CPI, consumer price inflation. By the way, 29% of the CPI is something called owner's equivalent rent. Another thing I've been over, it's a survey of households. They might call your household or mine and ask you when you answer how much you can rent your house for this month versus last year. So as much as I look at the market, I would not have a scientific answer for that question. I might look at my mortgage and add $100 if I was bullish, or subtract $100 if I was bearish. It's the most unscientific thing I can possibly think of, and it's almost 30% of the CPI. So this is a bogus, metric, like a lot of our metrics. And this is conference board inflation expectations gapping up. So what is the Fed going to do about this? They're controlling equity prices today. They're controlling Armageddon by preventing it. Remember, sinners in the hands of an angry Fed. But what can they do about prices, and especially inflation expectations? I don't know what they can do about that. In fact, this could actually become unhinged. Own gold or land or hard assets. Commodities do well in this environment, always, but nothing does as well as precious metals. This is the HUI index. It's one of the most widely followed indexes of gold mining companies. And it shows that they have 70% operating margins. Folks, these are pharmaceutical industry margins. These are software industry margins, okay? But you don't have to pay 40 times revenues for a cloud company's stock. 1 times revenue is what you're paying for a mining company. 5 times free cash flow. So this is an extraordinary time. You can't miss it. This is equities versus gold. By the way, gold's, as of yesterday, was in the biggest backwardation ever in history, where the spot price is well above the futures price. Tomorrow is options expiration date. Bullion banks are notorious for shorting the future, the long end of the futures in the gold market up to the day of the options expiration. And demand for physical gold is very, very high, which is why the spot price is so much higher than the futures price. That won't last. Today, we're getting a bargain in these companies, and tomorrow too, in advance of options expiration, when this whole thing unwinds until this next month. For the last 6 months, this has been the exact same behavior on the Thursday and Friday before options expiration. Whereas again, futures prices fall, spot prices higher, and the price of the mining stocks are getting hit, and they're giving you an opportunity to buy them. Hope that makes sense. And then while gold approaches its all-time high, the PME indexes, these are precious metals indexes, remain at levels from 15 years ago. And you can see this chart. So that, by the way, 15 years ago, gold sold at $500 an ounce. Now it's at $1,700 and something an ounce. So I'm about to go into Q&A. And before I do that, I wanted to tell a little story about my beautiful hometown of Nashville, Tennessee. Some of you may have heard of this. We've partially opened up, by the way, in Tennessee, and we're an amazing city, Nashville. We are stuck between the old redneck Nashville and the new modern urbane Nashville, which is, because we have so many newcomers. And there's no place where you can see the dichotomy between the redneck underbelly of Nashville and the new urbane Nashville than the Nashville Zoo, which has just had a mammoth multi-million-dollar upgrade. When you enter the zoo and you go to the first installation, it looks like any other zoo. The animals are roaming in the field behind the fence, and there's the sign there that has information about the animal. They have the name of the animal, the Latin name, the genus, the species, maybe the Greek name. They have the habitat. How many of these animals exist on Earth? But at the Nashville Zoo, unlike any other zoo, we've actually got the recipe and what whiskeys go with it. So, of course, while you recover from your laughing fit after that story, I'm going to now entertain questions. And I want to thank my dear friend George Smith, by the way, who is a voice of reason in my hectic world, and my good buddy Garrick Moran, who I should have mentioned in here, who's our trader and precious metals expert in Atlanta, longtime hedge fund manager, fine human being. And he has actually got a guy named David Tice, the Prudent Bear Fund you may have heard of. There was a famous fund a number of years ago that he sold, who's now found Garrick, and they're going to do a little JV in the precious metal space. So I'm very happy for Garrick. Nobody works harder in trying to get it right for his clients than that man. So from our team, including my fabulous son, our Chief Operating Officer, Fairfax Land Street, we want to thank you for being here today, and thank all our investors and friends, and so forth. So I'm ready for questions. How do we get any inflation beyond financial assets with capacity utilization at the lowest levels in recorded history? And that's a terrific question. Here's how we get that. Milton Friedman called inflation too much money chasing too few goods. We know where the too much money is coming from. How do you get too few goods? Well, how about this? A trade war with China that reduces the quantity of cheap goods coming to the US. That's one way. How about production shutdowns due to bankruptcies of companies or COVID sweeping through meat plants? That's another way. I think that the too few goods perhaps is coming. So we'll see. We'll see. And by the way, the Fed will not stop printing until they have beaten inflation, which means, not beaten, till they have created inflation. The Fed will not stop until they have created inflation. So that's a way to guarantee it. Will the U.S. government consider buying American mining companies as a hedge against as a hedge against itself? The answer is no. The government does not like gold, and they don't like Bitcoin. They do not like you escaping their grasp. What drove the increase in 2019? I think that's the question. Federal Reserve buying. Remember last year, the S&P was up 28.5%, but only 5 stocks were 70% of that move. And we had zero earnings growth last year. We'll have a significant earnings decline this year, and yet stocks may march to all-time highs. How big a difference will the inflation markets see with the Trump 2020 versus otherwise? I think inflationary risk go up significantly if Trump does not win, but I think it's a tremendous risk anyway. He's not talking about the deficit, and it bothers me a lot that he isn't. He's been pretty good. He's cut tax rates. He's deregulated. He's done a number of things that I approve of. I need him to start talking about the budget deficit. Will manufacturing come back to U.S. shores from China or go elsewhere? Both. Manufacturing will go to Mexico. It will go to the U.S. as well. We need to get rid of the minimum wage, we need to make it cheaper for companies to repatriate their manufacturing in the United States. The reason companies in the U.S. went to China is because we made it so expensive for them to manufacture here. We chased them there with the EPA, Federal Labor Relations Board, and high and rising minimum wages made it difficult to employ people in basic wage roles because it was too expensive. So we ran off to China, and that gave China the growth that they had experienced. So if we don't reverse some of those barriers, we will not see much manufacturing return to the United States. And I do not agree with Donald Trump's saying that he's going to make them do it. Now, if he gives them a tax cut, I guess I could deal with that. But the truth is we need structural regulatory reforms that lower the cost of companies bringing their manufacturing back to the United States. We're in a shock. Is tomorrow our day to put up or shut up on gold? Yes. With option expiration, yes, you need to buy today if you can. It doesn't mean the trade's over. You might get another opportunity next month on options expiration, but I think this group has left the station. When all previous goals had a low double digit or negative returns over a long period of time, why do I think now? Look, I'm not a gold bug, and I would not advise you buying gold all the time. I just don't think it's a great asset to hold at all times. Some people really do. But this time, in my opinion, there's no question. When you see how it behaved in the Depression, in the 70s, in 2001 with the meltdown, the internet bubble bursting, 2008, gold exploded 300, 400% to the upside. And I believe that we're there. So it's a now thing. It's not a permanent thing. And where do you see the 10-year Treasury going at year end? I think the Fed's going to target interest rates, meaning cap them. Look, the long bond's actually ticking up here a little bit. At some point, investors are going to want to properly price federal government debt, which contains more risk now than it ever has, with declining tax revenues, a depression in the economy, not just a recession. This is a depression. They're going to have to cap rates. So the answer is, just because I'm looking ahead to see what the Fed's doing, and I believe that they're going to cap rates, I don't see the 10-year going up much, to answer your question. It should. It should go up if it was properly reflecting the amount of risk. Another thing is, I would expect the S&P to downgrade U.S. federal government debt. They did it in 2011. You know that? Remember that? The market fell 600 points in a day. And you know what? Within 1 month, the CEO of the S&P, the rating agency, was out of his office. So the federal government applied so much pressure to them for telling the truth that within a month's time, the CEO was dismissed. Tell me what CEO at Fitch or at Moody's or at S&P is going to be interested in telling the truth about our federal government deficit now? Answer is nobody. We're in a big, big problem here. Have you seen any information on how much debt the Treasury is going to issue in June of 2020? Yes, I have. And I know who asked this, so I will get back to you. It's extraordinary and rising. What are my views of cryptocurrencies now and going forward? Governments hate them. And I'm scared of government. Look what it's doing right now. I like the idea of a cryptocurrency. I think it's very cool. And it might or might not be a surrogate for the 4,000-year-old precious metal. Gold has shown these same characteristics for the 4,000 years, and meaning it's a store of value. By the way, it's not a promissory note, which a dollar, as you know, is a promissory note. It's a debt instrument. Gold is not. I think these times are so unprecedented that gold is the answer. Bitcoin is a fun diversion. The U.S. needs to update its infrastructure in order to stay competitive. Yes, it does. But what happened to Barack Hussein Obama's shovel-ready infrastructure, trillion-dollar spending bill? No one can tell me where that money went. Not a pothole was fixed. So yes, we need infrastructure spending, but I don't trust the government to do it. They will misallocate the money, okay? They'll pay highest union wages and we'll get less per dollar through that avenue than any other avenue. I don't know the answer to that, but yes, our infrastructure is crumbling and our government's totally inept and compromised. So I wish I could say, yeah, an infrastructure spending plan is a great idea. It is. It's much better than sending people mailbox money, but I don't trust the government to implement it. Once again, what are the better mining companies to buy? Let's talk offline. As you may know, we are managing separately managed accounts for individuals that want exposure. And we have 30 or so, no more than that, vetted names. We know them extraordinarily well. And we are managing portfolios for people who want access to this asset class. Do you think equities will retest or go below the lows they hit on or near March 20th, 23rd? The answer is, I would have thought we would have retested, but now that the Fed has gone absolutely berserk, I don't know. I can't say it. They're not, this is an angry Fed. They're angry. How dare you sell off stocks? How dare you downgrade U.S. debt, CEO of S&P? How dare you go against the government? And in that environment, they'll buy every damn stock out there. They may start buying stocks. So the next train wreck, though, will retest those lows. It will. It'll be a glorious, violent downdraft in the market. Barrick's down 10% this month. Newmont down 6% this month. Will they turn around more versus comparable time last month? Great question. Those companies had the best performance among all gold stocks, as you probably know. Chart that one against maybe Kinross, KG, and you'll see there was a significant outperformance. So they had run way ahead of themselves. They were trading at 20 times, by the way, cash flow. There are other ones that are trading at 5 or 8 times cash flow. So, I think that there's just maybe a rotation out of those names into the smaller miners. And you know what I think? I think they're going to be making acquisitions like crazy this year. So you can get in front of that acquisition frenzy by owning the smaller miners. And then somebody told me, what's wrong with mailbox money? They like mailbox money. Well, I don't even know how to answer that. But there is something wrong with mailbox money. You're paying people for something other than work effort, and there's friction to that. So do I have any more questions? I hope I answered them all. And I think that's it. I really appreciate you guys participating in this. I hope I'm helping you out. And I'm going to do another one in a couple of weeks. Until then, take care and be safe. See you soon, I hope. Bye-bye. I think I'm done. Good job. You think so, really? Yeah. Oh, leave meeting? Am I still on? Hi, everybody. I'm still on. Shut your damn computer. Bye, everybody.